All right. So today we're going to talk about 112 bear traps. Specifically, what we are going to look to do today is to set up a new trade, which I normally take on Tuesdays. This is a part of the 112 bear trap campaign that I have been running for some time now. We are going to use SPX options, and I know that this isn't for everyone. As we have talked about before, SPX 112s are best in portfolio margin accounts. For those with portfolio margin accounts, unless you can trade, and this is just my preference and personal opinion, unless you can trade at least 3 contracts of SPX or more, I think it is best to use XSP, which is 1/10 the size of SPX, has exact same grade, tax treatment. Liquidity is just as great as SPX. And being able to do a larger number of contracts in XSP allows us to make incremental adjustments throughout the cycle. If you do one SPX contract, you can't make any incremental adjustments, meaning you can't close half the position. You only have one contract. You either on or in or out. With XSP, 10 XSP contracts equals to 1 SPX contract. So if you are trading 10 or 20 XSP contracts and you wanted to close a third of the 10, right? You close 3 or 4 of the 10, makes it a lot more flexible. We are going to look at SPX, and as I just said, we can look at XSP, same strikes, same expirations. For those that like to trade utilizing leverage with span margin, could possibly look at setting up similar or same trade in the same expiration cycle using ES or MES options as well. First, let's take a look at a few positions that we are currently holding as part of the 112 Bear Trap campaign. We have a couple of trades that are going to run off in the next couple of weeks. First up is the trade number 2757. And if you are looking for these trades and you want to see what exactly happened here, we have in this specific trade 2757, we had entry on October 24th. We had one adjustment on November 15th. If you want to go back and see what took place in this trade, you can go to Iron Mod Trade Alerts. Under My Trades, Igor Iron Trades, you can search. You can just put in 2757 and the 112 SPX. December 15th is going to come up. And you can see I leave notes and comments and every adjustment and everything that I do with the trade. I post onto that trade thread, and you can follow along and ask questions as well. So with this trade, I believe the only thing I did was I removed the naked puts. This left me with a put debit spread. And now this trade has 10 days until expiration, so it's going to run off not this week, but next week on Friday, I believe. And this is what this trade looks like. We have a put debit spread that is currently providing a hedge for some of the trades that we took in the recent weeks. Very similar. This is December 15th. The very next one is the 22nd. So on the 22nd, we have not removed the naked puts just yet. I like to take them off when the naked puts lose about 90% of their value. We can see here, I did not set a GTC to close order, but we can look at the original price for the 3,900 puts, which are currently about almost 15% out of the money with 17 days to go. These puts were sold for $10.34. They're currently going for 65 cents. So closing out these puts will leave me with a long put debit spread, and let's see what this position would look like. Bear with me just 1 second. I'm not sure why OptionNet Explorer is showing me a completely different risk profile. If I was to close the 3,900 puts, if I was to buy to close these, this wouldn't be a new trade. This should leave a put debit spread instead. OptionNet Explorer is showing me something completely different. But if I was to buy to close the 3,900 puts, my risk profile would look something like this, with just the long put debit spread, which will likely to expire out of the money, meaning it would expire worthless. And for the next couple of weeks, if the market does pull back 10%, which is very unlikely, but if it does, this would provide a really nice hedge for trades that we took and that we have currently running in the December 29th and January 5th expiration cycle. This is the trade that we took, and this was a scaling trade. This was a 1-1-1, so I had 3 tranches going. And as you can see, over the past 39 days, this is how long this trade has been on. The market, or SPX, moved almost 2 standard deviations higher. Volatility had dropped off, and you can see on the chart, right, this is where I initiated the trade, and I planned on scaling this trade, meaning adding tranches up to 3. So we started off, and we can see that the market was right around, let's call this 4,100. So we initiated the trade when the S&P was at 4,100, and now we are, over 450 points higher. So as the market was moving higher, I kept moving my 1-1-1 traps higher, and the market is still running away. I managed this trade in a way that I did not have any upside risk, meaning that if the market continues to move higher, I'm going to try to move my traps closer and closer to follow where the market is without paying any debits, meaning that if the market continues to run higher and I stop doing anything, I stop adding anything, I stop rolling anything, I would still not face any losses on the upside. So with all of the adjustments that I have made, I am now holding about an $800 net credit. So if inside of the next 24 days, or let's say at expiration, December 29th, if S&P is above my highest long put, which is at 43.75 currently, it's right here, right? So let's call this about 4% out of the money. So if S&P is above 43.75, all of these options are going to expire worthless, and I will keep the $800 credit that I was able to collect throughout making all of the adjustments. And this is a trade number 2758 for those that want to go and look at all of the adjustments. We had entry here. I added another tranche here. I added one more here, and then I had one roll up. This was on November 13th, and I haven't really done anything else to it since. Just kind of waiting to see if the market is going to settle. I don't want to aggressively move my traps closer and closer, meaning forcing the traps onto the price, because if we do get some sort of reversion back to the mean, and you can see how far, again, the market was a little bit oversold here when we first took the trade, but as you can see, based on the what the market was pricing in, on October 27th when we took the trade to today, we are up almost to, I guess the better way to put it is that there is a chance that we may come down and still end somewhere inside of the one standard deviation cone, which would be somewhere around between 4,300 and 4,200. Between 4,300 and 4,200, this will be a really, really great sweet spot for this trade. Currently, over the next 24 days, what the market is pricing in, right, this darker gray area, this is a one standard deviation based on current implied volatility, and the market currently is pricing in a move down to about 44.25 or up to about 47.10. Right, so we would need to see a two standard deviation move to the downside from today's level based on today's implied volatility in order for this trade to come alive. So this is more of a hedge, I would say, at this point or at this stage of the cycle, right? When we took the trade, it wasn't a hedge, and this trade is not really a true hedge, because if we do see a two standard deviation move to the downside, even though this risk graph is showing a really nice profit potential at around 4,300. If we just take volatility up a little bit, you can see the T+0 line dips below zero, and this trade will show losses. This trade becomes a true hedge when there's very little to no time left, like in the last 3 days, maybe last week, right? So we can also take a look at what this trade would look like with 7 days left. So if we're here and we have 7 days to go, you can see that it's very unlikely that we're going to move much lower. But if we do, right, you can see that the T+0 line really comes alive. And that happens at 44.50 or below. So if we move down to 44.50, this trade will increase in value because these debit spreads are going to increase in value, while the naked puts are really not going to do much. But if we move down to 4,300 in the last 7 days, and we can take volatility up a couple of points, right? Even with volatility increase by about 10 points, it's like VIX going from 13 to 23. The T+0 line is really going to be in a good spot. And that only happens in about a last week. Right. So right now, with 24 days to go, it's still really not a hedge. You can look at it as a hedge against the slow move lower. But if we move down 2 or 3 standard deviations from today's prices, this trade could still come under fire and potentially get in trouble. All right, so it's very likely that I will not continue to roll, only because to make any adjustments to this trade with only 24 days to go, for it to make sense, I would have to probably pay a debit. I don't want to. So I would rather leave this trade as is. And if the price is going to revert and we end in the trap, great. If we don't, this trade will not lose anything. So I'll just leave it at that. So that's 2758. Trade number 2758 for those that want to go and take a look at the progression of this trade. We have another December 29th. This is a trap that we took 28 days ago. We can look at the price chart, and we took this trade as the market started to break above the 50-day moving average. We had 8 and 21 EMA cross bullish. So the market was setting up bullish. I haven't done anything since. SPX moved 1.25 standard deviations from when I took the trade. And right now, with 24 days to go, again, the market is pricing in the move down to about 44.25. So it's very likely that if we move within what is currently being priced in, all this trade is going to make is the tail profit. And if we move more, if we move 2 standard deviations to the downside by expiration, there is a chance that we may end up in the trap. For those that may be slightly advanced, question for you guys: what is the probability, based on current implied volatility, that we end up somewhere above the 4,300? Going to give you a minute to think about it if you want to take a shot. What is the probability of SPX being somewhere above 4,300 at expiration? I'm sorry. I said above. The question is what is the probability of SPX being below 4,300? But if you answered above, yes, 94% is correct. 85 is close. 90% is close. But we can just look at the delta of this put. 4,300 put is currently about a delta 6, which means that there is about a 6% probability that this put is going to be in the money at expiration, which means that there's a 6% probability that SPX will be below 4,300, or there's about a 94 and 95% probability that SPX is going to be above, right? There's a 95% chance that 4,300 is going to expire worthless, which means that there's only about a 4, 5, or 6% chance that this trap is going to be worth anything at expiration. That's that. And then we have the most recent 112 in the SPX that we took. This was 19 days ago, and the market still moved slightly higher, right? We're up about 0.7 standard deviation. So nothing that wasn't being priced in. And right now we have 31 days to go. We have, this is the darker gray area is what is currently being priced in for January 5th expiration. So if we do move down about 1 standard deviation by expiration, there's a chance that we may be somewhere inside of our long puts, which are currently at 44.40. And again, this is exactly what we just did. If we look at the delta of the 44.40, currently delta 20, which means there's a 20% probability that at expiration, SPX is going to be somewhere below 44.40. There's an 80% probability that this trap is going to expire worthless. And that's at expiration. And if you want to go one step further and you can guesstimate the probability of touch, meaning what is the probability of SPX touching 44.40 before expiration, you look at the delta and you multiply that by 2. So there's about a 40% chance that we may still tag this 44.40 strike anytime before now, between now and expiration. All right, so let's take, I don't know what trades you guys are in. I did see Mark said that he's at a loss with the XSP, with the scaling, with the scaling 111. And that's probably because whatever scaling you did, if you paid a debit, then you obviously introduced upside risk. This is the trade 2758, right? So if you make any adjustments, if you roll or if you add 111s and you do those for a debit, right? The risk graph at expiration is going to dip below zero, and that, based on the screenshot that you shared, that's exactly what that looks like. With 24 days to go, and again, I can't tell you what to do, but if you wanted to fix that, and I'm not sure how much of a loss, so you're down, and this is based on the screenshot that you shared, so you're down about $103. Okay. In order for you to recover this $103, how do you recover that? So if this, if XSP expires where it is right now, right, you're going to lose about $103 or so. So in order for you to get to a break even, what do you have to do to recover the $103? I think the answer is pretty simple, right? You have to sell something to collect $103. If you sell something on the downside, or if you, want to take some upside risk and sell some out of the money calls or call spreads, whatever you're selling, you need to collect $103 to recover the debits that you paid while, moving the tier 1 or tier 2, whatever you were doing, whatever adjustments you were doing, the debits that you paid, you need to now recover that. And one way to do it, I would probably look to either sell maybe one more put, or maybe sell 2 more puts naked to collect $103. Whatever those puts may be, you just have to look at the price. You can also sell a naked call to collect the $103. You can also do spreads. But in the end, your goal, your objective is to recover the $103. Right? So when I was making adjustments here, my goal was to not pay a debit. If I can do it for even money, that's great. If I can do it for a slight credit, that's great too. So I ended up collecting about $800, and that's not factoring in the commissions. So if SPX stays above the 43.75, I'm just going to keep whatever I had collected throughout all the adjustments, and everything else is going to expire worthless. All right, so let's have a look. Today is Tuesday, December 5th. So on Tuesdays, I usually put on a 1-1-2 bear trap as part of the campaign that I have been running all throughout this year. And we're going to look for a new trade setup. And my target DTE is 52 days out. Usually on a Tuesday, they have an expiration cycle that has 52 days in it. And today, this 52 DTE happens to be January 26th. Now, for those that want to follow along using ES or MES, I know that the option code, or whatever that's called, is extremely confusing. If you are using Tasty Trade platform, they don't list ES or MES options based on the date. So the best way to get to where you want to go is to look at the DTE. So here we have 52 DTE. And that's going to give you your target expiration cycle. So 52 DTE is our target expiration. We're going to, and I'm going to use OptionNet Explorer to model this trade. You can use your broker platform that you're using and look at the risk profile and analyze the trade to see if this fits within your other trades or your portfolio. And one thing I wanted to mention is that, you know, all the trades that we just looked at now, right? So I have a couple of leftover put debit spreads. I have a couple of 112s that are maturing, and the delta is relatively flat. They will eventually turn slightly, very slightly negative. So right now, my deltas are negative in my 112 portfolio. So that kind of tells me, right, how I want to set up my new trades. If I was running an inventory of 112s and my net delta was very positive, right? Just looking at the price chart, I have to think the next trade that I'm going to take, do I want that trade to be long delta? Do I want it to be short delta, or do I want it to be more or less neutral? Right. So I'm going to go with probably 112 that is a little less bullish than I would normally take. Right. I don't want to take on any more short delta. I have those. I'm going to go with a neutral to slightly bullish. And the reason why, not only because I'm already holding a couple of positions that have short delta in them, but just, you know, looking at the couple of indicators that I like to look at. For SPX, we have RSI at 67. So it's not screaming overbought, but we have been overbought for some time. And we're just kind of working off that overbought readings. We have MACDs are kind of starting to flatten out. We're still above zero line, but if MACDs cross over into a sell signal and then we dip below zero, which will confirm the a downtrend, we're still in an uptrend, if you want to call it that. But I think that the market is consolidating under 4,600. This can take another week, maybe two. Maybe we do need to pull back and retest, right? We're just starting to kind of chop around the 8-day exponential moving average. Maybe we come down and test the 21 EMA. Maybe we come down and test the 50. Who knows? But the point is that the market has already made a nice move. Now we're just trading sideways. Do I want to take on a ton of positive delta right now? No. Do I want to go short? I don't. So I'm going to try to go with a position that's neutral to slightly bullish. So first thing I do is I need to figure out how much directional exposure I want to hold in my new trade. So I'm going to go with a very typical put debit spread, which is going to be 50 points wide. And I normally look for a 50-point wide put debit spread for about $10 or $11 debit. I did model this trade a little bit earlier today, and these are the strikes that I came up with. So 45.20 for the long leg. And then we go down 50 points to 44.70. That's the short leg of this put debit spread. And this put debit spread is currently going for $12.20. So it's a little bit more than what I normally go for. So this put debit spread is going to neutralize the naked puts that I'm going to sell. So if I'm trading a little bit closer to at the money with my put debit spread, that's going to give me less positive delta overall for this trade. If I wanted to go and set up a trade that was more bullish than neutral, then I would have to either sell the naked puts closer to at the money, or I would have to move my put debit spread further away and pay less than $12.20. So I'm going to pay $12.20 for my 50-point wide put debit spread. And normally I would sell out of the money puts that are trading for exactly what I'm paying for the put debit spread. Meaning if I bought the put debit spread for $12.20, I need to scroll all the way down, and I'm looking for a put that is trading for about $12.20. So we don't have a ton of puts available under 42.50. The closest we have is 42.25. So normally I would probably sell a 42.25, and I would sell 2 of these puts for every 1 put debit spread that I'm buying, right? And you can see that this risk graph, we have plus 10 delta per 1 contract. But since I want to take a position that's a little more neutral, I'm going to go down to 41.50, which is currently going for $9.50. So if I sell 2 of these, you can see that my delta is now, instead of being plus 10, it's plus 5. So I have half of directional risk than what I would normally go for. And again, that's only because, and this is my opinion, if something changes, right, if the market starts to run away from me and I feel like I'm being left behind, I could always add more delta by either closing some of the put debit spreads, or maybe selling something else way out of the money to increase my directional exposure and bring in a little bit more credit on the upside. So Peter is asking, how much buying power does this take? Again, for SPX options or SPX 112s, you have to use a portfolio margin account. If you look at a Reg T 112 in SPX, you're going to see some crazy numbers. They're going to think that we're mad. But in the portfolio margin, I think that each of these 112s will take up somewhere between $25,000 to maybe $30,000. In the portfolio margin, one lot SPX 112 will normally take up somewhere around, let's call this $30,000. If you're using XSP, which is 1/10, it should be 1/10 of that. So probably somewhere around 3,000 per 1 contract. Now, I'm not sure, Peter, who your broker is. In your PM account, it's about 50K. Maybe, let's see. I'm going to put this into my Thinkorswim. And again, it also depends, right? If you have some other positions that are maybe net long premium to the downside, that could potentially offset the buying power that is required. Yeah, Tasty may be a little bit higher on Thinkorswim. Hang on, I'm putting this in as I'm talking. So for a 660 credit with no, that's pretty close. So this trade setup is showing me a buying power requirement of $48,580 per 1 contract. And that's So when I said that, a normal or a typical 112 will take up somewhere between 25, maybe 30,000, is because when we put on these trades and implied volatility is higher than where we are right now, right? You can look at implied volatility for 52 days out is around 12. All right, I'm going to double check to see what implied volatility is showing on Thinkorswim. So 52 DTE IV right now is at, so Thinkorswim has it at 13.15. So 12, 13% implied volatility for 52 days is relatively low, which means that we could only go out so far on the naked puts, right? You can see that my naked puts at 41.50 are about 9% out of the money. That's relatively close if we look back on all the trades that we have taken so far this year. When volatility was, in the mid to high teens, we usually go out maybe 12% out of the money. So the farther away we put our naked puts, the less buying power our brokers will require us to put up. When we are putting on 112s in a lower, and this is in relative terms, in a lower IV environment, the broker is going to calculate a higher buying power requirement for this kind of trade. So right now it does show about 48,000 for one contract, and our choices are very limited. Either not do the trade or go to XSP and do multiple contracts instead of one big S&P 500 contract, or use span margin and use ES or MES options. So another question, what percent of buying power do you use in a PM account? I like to keep 50% of buying power available at most times, especially in times like now when implied volatility is relatively low. You don't want to have 75 or 80% of your buying power used up right now, because if, and again, this is an if, the market does pull back or volatility is going to increase, that's going to draw down on your buying power. If you used up 75 or 80% or more of your buying power when the VIX is at 13, what are you going to do when the VIX is at 19, 20, or 25? Odds are you're going to have no more buying power. You're going to be in a margin call, which will force you to probably close out some of your positions at the wrong time. So when the market is where it is right now, or when volatility is relatively low, I would want to keep around a 50% buying power available. So if my buying power is used up and it's time to put on a new trade, either I need to remove some of the parts of my other trades in order to make or to free up some of the buying power to take on new trades, or skip new trades altogether. All right, so let's come back to this trade. So this is my trade setup. So normally I would put on a trade like this and I would look for about a $10 credit. I'm willing to take less credit up front, which gives me less directional risk up front. And again, the way I trade these 112 bear traps is slightly different than maybe what you see from Tom or anybody else that posts their trades in our group. There is no right or wrong. You just have to do what is right for you and your portfolio, right? These are just puzzle pieces, and we have to put a big picture together. So for me, I know that if I'm taking less credit up front in exchange for less directional risk up front, because it's not really clear if the market's going to continue to rally, right? Everybody's waiting for the Santa, but what do you think this was? Right? I'm not saying that Santa isn't coming, but I just don't want to have a ton of directional exposure from the get-go, but if something changes and I feel like I'm being left behind here, I can always do something to this trade, such as maybe roll my 4520 down 20 points to 4500, collect a little bit more credit, right? Unlock some of that potential tail profit, but the market has to give me the signal first. So for right now, I'm taking less credit up front. I'm taking less directional risk up front, and I'm going to let the market dictate if and what I need to do next. From here, we have three potential outcomes. We know our tail profit is the credit that we take up front, which is about $6.60 or $6.80. So if at expiration we are above 45.20, which is the long leg of the put debit spread, we're just going to keep what we collect up front, and everything else is going to expire worthless. Scenario number two, which is the best case scenario, this is the bonus or the bear trap profit. If we are inside of the put debit spread and the short naked put strike, somewhere between 41.50 and 44.70, this 50-point wide put debit spread is going to be worth 50 points or $5,000 per one contract, plus $6.80 that we're collecting up front. This trade in the trap has a max potential profit of $5,000 plus $680. So we can call this about $5,600 or $5,700. And then the worst case here is if the market tanks and we have to stop out. Now, when it comes to stop losses, there's no right or wrong way to do it. You can use some multiple of your tail profit. You can use some multiple of your bear trap profit, or you can use some dollar amount that you're comfortable with. It really has to work for you, right? What I do is I use my max potential profit inside the trap. So let's call this $5,600. So if this trade is down between $5,600 to maybe $6,000, that's my exit. That's not my adjustment point. Whenever this trade is down $5,600 to $6,000, there's no more thinking. There's no more asking. It's time to go. So right now you can see that, where does this trade show a loss of about, $6,000? It's at about 42.90 level, right? So if we go down to 42.90 today and this trade is down $6,000, it's time to get out. That's my stop. And then with every passing day, you can see that, T plus 44 with 8 days to go, where does this trade lose 6,000? That's going to be all the way out to about 41.20. So the longer we stay in this trade, the farther away our stop out level is going to move. So if we go down early on in a trade, try to follow me here. Right, I'm looking at this minus 5,000 number. So if we come down to about 40, let's call this 4,300, right? At 4,300, this trade is down $5,700. That's my exit. That's my stop loss. So 4,300 today. Let's look at this 30 days from now. Where is that minus 5,000 number? Now it's at 41. Let's call this 4,200. So in 30 days, right, my stop goes from 4,300 to 4,200. So the longer it takes for the market to go down, the higher the chances or the higher the probabilities that I'm not going to get stopped out at 4,300. Right, in 30 days, my stop is now at about 4,200. If we go forward, maybe another 15 days, where is it minus 5,000 level? Now it's down to about 41.25. So as you can see, as the time goes, my stop loss goes further and further away from where the price is. So now I know my three potential outcomes. Outcome number one, I keep the tail profit or the credit that I'm collecting up front. Potential outcome number 2 is we're inside the bear trap, and we're going to make the full value of the put debit spread plus the credit, or we hit our stop loss, which is going to be about my max potential reward inside the trap. So if I'm going to make $5,700 inside the trap, that $5,700 loss is going to tell me when it's time to take the trade off. I'm just looking at questions. What's the preference for 112 campaign versus 112 LT using SPX? There is no preference. So I trade 112s in different variations, right, on different time frames. I don't trade 14 DTE, which is not a terrible trade. It's just it doesn't really fit within my trading style or my trading goals. I like to go at least 52. So 52 DTE is kind of like where I start, and I put on trades also at 90, at 120. Some are put on for a net credit, some are put on for a net debit. But I know that if I put on a 112, 120 days out, and I'm paying a debit up front, I'm not going to fall asleep and let it expire out of the money or outside of the trap, and I end up losing the debit. I know that at some point between entry and exit, I will need to make some kind of an adjustment to recover the debit that I'm paying up front. So I don't personally, I don't have a preference for a 112 bear trap at 52 DTE versus a 112 LT at 90 or a 120 DTE. Again, it all depends on your preference, I guess. You have to, there are two, right? There are two sides for one versus the other. So the 52 DTE versus 120 DTE, you'll get to do 2 of the 52 DTEs in the same time it takes you to do one 120 DTE trade. So 120 DTE is going to be slower moving, which means that if you look at your P&L per day, you're probably going to make less with a 120 DTE 112. But the flip side is that 120 DTE 112 is going to be a lot more forgiving. And if you have the tools, you can just compare the two trades, one at 52 and one at 120 DTE, and look at a 3 standard deviation move within the first week, and look at the P&L of 52 DTE versus 120 DTE. And I'll just tell you that the 120 DTE is going to be, it's going to suck less. Okay, 52 DTE is going to really take a hit because it's closer to expiration. It's a little more sensitive to price change. So, but the 120 DTE is going to be a little bit more sensitive to implied volatility change. So there's the good and the bads. I prefer to trade further away in time and size trades a little bit bigger with more time until expiration, because I have more time to be right. That's number one. And number two, I have more time to fix the trade, right? The shorter the duration, the less room for error you have. Another question, do you always use a stop that equals to a max credit potential? That's what I use. Is that right? Is that right for you? Maybe, maybe not, right? You just have to use whatever is within your risk tolerance. So if, for example, right, we're looking at this trade here, and I said that if this trade is down $5,700, that's my stop. If for you, $5,700 is going to be 15% of your overall account, clearly that's not the number you should be using. You should not be using SPX for this trade. You should be trading smaller, right? Or maybe if you want to trade this, but you can only take a loss of I don't know, $2,000 instead for your account, your stop is going to be much tighter, right? So minus 2,000 for this trade is going to be at around 4,400, whereas my stop is going to be down to about 4,300, right? So you have to figure out what your max allowable loss per trade is and size your trades according to your number. I think that's the right way to do it. So Peter says, so I gather you would sell the whole thing or just the naked puts, which are causing the, well, I wouldn't be selling the naked puts. You mean I would be buying back the naked puts, which are causing the drawdown? I think that that's not the right way to think about it, right? You can't think about, oh, what's causing the drawdown? It's everything together, right? Because if I put this trade on and the market tanks, yes, the puts are causing a drawdown, but they're not really in trouble, right? We have to assume that implied volatility is going to revert, and that's going to help the naked puts. So why would you want to buy them back when implied volatility is flying high, right? And at the same time, what happens is this put debit spread is not really giving you the hedge that you're looking for against the losses in the naked puts, because there's still a lot of, well, it also depends on, how fast we see the move. But if it happens early on, the put debit spread isn't really providing much of a hedge against losses in the naked puts, because with a lot of time until expiration, there's still a good chance that this put debit spread is going to expire out of the money, right? If you think about it for a second, we just looked at this put debit spread that's going for about $12. If this put debit spread goes in the money next week, is it going to be worth $50? We know that it has a max potential value of 50 points at expiration. But if this put debit spread goes in the money next week, it's probably going to be worth under, $15 at most. Right. So while these naked puts are going to take on a ton of heat, a $3 increase in the value of this put debit spread isn't quite enough to offset the losses that will accumulate with the naked puts. So closing naked puts is really not the answer. If you wanted a quick fix to kind of maybe give you an opportunity to hold on to this trade to see if we do get some sort of reversion, my go-to potential adjustments are just, fix my delta problem. So if we, if we go low enough to put this put debit spread in the money next week, and we can see what T+7 would look like, right? And, based on current implied volatility, going low enough to put this debit spread kind of halfway in the money is really not out of the question. Right, we would only have to move down one standard deviation according to today's implied volatility, which is relatively low. So if we are going to head towards 4,500, we're probably going to move more, because as implied volatility starts to increase, we usually move more than what is being priced in before the actual move. But to answer your question, so let's assume we see in 7 days, we see a one standard deviation move to the downside and, a slight uptick in implied volatility. Let's say we get down to 44.70, which is where my short leg of the put debit spread, right? At 44.70, like, we still have all of this room here, right? It just happens early on in the trade and it's not going to feel too great. So I could see that, at 44.70, in the next 7 days, my net delta is about +20. So I'll go from +5 delta, which is what I'm seeing right now, right? On entry, my directional risk is only 5 delta. If we move down to about 44.70, now my net delta is +20. So I have a delta problem here. And all I have to do is look for a way to remove some of my directional risk, right? So I need to bend my T+0 line and make it go from, sloping downwards to kind of get it to be flat, right? And that's usually, if I needed to add, or if I needed to add 20 negative delta, I can just buy 120 delta put, and that's going to take my delta back to zero and make this trade relatively neutral until the market dictates the following adjustment, which is to unhedge this trade. So that's the idea. I'm going to send this order in. I am buying to open 45.20 put. I'm selling to open 44.70 put to make it a 50-point wide put debit spread. And then I'm going to sell 2 puts at 41.50 for every 1 put debit spread that I'm buying. This trade is currently going for about $6, and I see mid price 680, 690. So maybe I'll start with a 690 credit. And if it doesn't fill, then I'm going to maybe take it down a dime to 680. If it still doesn't fill, maybe I'll take it down a little bit more. And you know what? If it doesn't fill at 680, maybe I'll go down to as low as $6.50. And that's that. And if I get no action, no problem, because I can come back tomorrow and set up the exact same trade all over again and see where the market is going to bite. So for right now, I'm going to send this order in for 690 credit. And so far we have nothing. And I'll just let it, we have about an hour left in this trading session. Just going to let it hang there. And, if it doesn't fill again, I'm going to go down from 690 down to 680, down to 670, 660. And I'm going to probably stop at 650. Like I'm not going to go lower than 650. If it doesn't fill, then that's fine. We'll come back and revisit tomorrow. Or if I really wanted to get this trade in and I'm not getting a fill at the price I want, instead of lowering prices, which is nothing wrong with it, we can, lower, and that's okay. I would probably just move my naked puts from 41.50 to 41.75. And these are currently going for about $10.30. So now the net credit for this trade goes from 680 or 690 to about 860, right? So we've taken a more credit, but we're also taking a little bit more risk, and we have a little bit more directional risk because our naked puts are 25 points closer to at the money. Mark is saying there are many more strikes available at 57 DTE than 52 DTE, which is totally fine. Again, if you want to go to 57, there's no one out there saying that, 52 is that secret number. Go to 57. Yes, I like 57 DTE, but according to what I am doing, 57 DTE will become 52 DTE in 5 days, so I may revisit that. But I'm going to try to stick with 52 DTEs. And again, if I don't get a fill, no problem. I'll come back tomorrow, set up this trade, same exact way that I just did today, and kind of go from there. All right, I'm going to post this trade in the alerts channel. If you guys have any questions, you are free to ask pertaining to this specific trade on the post that I'm going to put on in the alerts section in our Discord. And we go from there. I'm going to hop off now. Thanks for taking the time. We'll see you guys later.